Welcome to the daily update, where I'll go over the action in the market for Tuesday, April 15th, and we'll see how things look for Wednesday, April 16th. We're still seeing some small, subtle improvements, but at the same time, we're not seeing any kind of a switch going from value back over to growth. That's what we really need to see happen if we're going to be able to show some strength with the indexes. But we had a really quiet day, which is kind of typical of what we see after the big couple of weeks with the all the volatility and everything. You got a lot of folks that are exhausted, things kind of settle down. The more we stay stable though, the and the longer that happens, the more the breakout is going to be, either to the upside or the downside. Right as I started recording this, there's news out after the close on Tuesday that NVIDIA is getting hit with some uh, like $5.5 billion in tariffs dealing with China. And that has the futures down about 1% after the close on Tuesday. Now, as I record this, also, Europe hasn't opened yet. It's many hours before the market is getting set to open. So there's a lot of time. And time is a variable where things can happen, get worse, get better, stay about the same. Okay, so let's talk about right at the open. We had a flat open and prices stayed in a tight range for about the first half of the day. We ended up staying above the daily pivot at 5408. So we're dealing with that 5400 level. Then, as the day went on, we drifted below the daily pivot and then just kind of chopped sideways. And we ended up closing slightly negative. We were down 0.17% on below average volume. That's 2 days now that we've seen volume dropping off. Not a real surprise. It's also a holiday week. The markets will be closed on Friday in observance of Good Friday. And we're still negative in the short and intermediate term. We have the short term moving average that is acting as overhead resistance. We can't seem to break above that. We can't seem to get above the highs that were set last week because there's not a lot of conviction behind the kinds of stocks that really boost the index up. And interest rates are still coming down, so we're not seeing all the craziness that we were seeing last week, where we jumped 0.5% just within 1 week. So we're coming down a little bit with that. We saw a little bit of a bounce in the dollar, and a lot of this is just tariffs. Now, if we get more tariff news that affects companies like NVIDIA and AI related type of stocks, that's going to hurt the market. So we'll have to see how that plays out. Okay, so some comments. President Trump did come out and say that there could be tariff adjustments for the auto sector. And it was reported that talks between the EU and the US were not really doing all that good when we're talking about trade. And the Department of Commerce, they launched, of course, everybody knows this, the Section 232. It's what everybody fears. Their investigations into imports of semiconductors, semiconductor manufacturing equipment, pharmaceuticals, ingredients, piquing concerns about tariff increases. So this is still in the news. It's probably going to stay in the news for a while, and this is what they have to the market on edge. We did have the Bank of America and Citicorp. I remember when C meant Chrysler. Now it means Citicorp. They reported earnings. Both of those stocks ended up being up, and that gave some support to the financial sector and to the market. We're still above 30 with the VIX at 30.12. It's coming down, but it's still above 20. And that's when we see the negative annualized returns with that chart that I show periodically put out by Tom Bowley. Okay, and we're now seeing a death cross in the S&P. All right. We're going negative there. The Dow is still holding out, but we also have death crosses with the Nasdaq after last week, the Nasdaq 100, excuse me, small caps, mid caps, micro caps, and then a broad market measure, the Wilshire 5000. We're still looking extreme. Mainly it's with the oscillators. They take longer to move, and they were going down and giving some really extreme negative readings. They're trying to improve, but they're still extreme, and it's going to take a lot to bring those back. And we do have two extreme positive indicators right now. The same ones that were on the list after Monday, the Stochc RSI, it's a really touchy short-term indicator, and then the rate of change going back over the last 5 periods. Intermediate term, we're improving, trying to improve with the TTM squeeze. The PMO studies that I showed, that's fallen off the list, but the PMO itself, the price momentum oscillator, is still extreme. The Copic curve is still extreme, and we're still far away beneath the 50 period moving average. That's what the boom indicator measures. And then in the long term, we're still looking extreme with the 150 period simple moving average. No real change to the scenario with the Feds. They're fearing that inflation's going up and that economic growth could go down. And they're kind of in that area for right now. The dollar was up. As I said, we got back over 100 with the index, and interest rates were down. We're at 4.32% with the 10-year yield, where we had been at 4.36%. And we didn't see a change with sentiment. You still have a lot of cautiousness out there. We're below 25. We were at 19. We're still at 19. And we're negative with our trend. The ADX is weakening. It's dropping down below its moving average. Now, that doesn't mean the trend is going away. It just means kind of what we're seeing right now, slower action in the market currently, but it's still a trend because it's above 20. And I have our bias at mixed because we really didn't have any kind of a conviction either to the upside or to the downside. And I'm keeping the longer term momentum, last 2, 3, 4, 5 days together, is mixed to leaning more negative. We have a good solid update that could switch over and look more positive. We just had the Empire State Manufacturing, which came out, and then a bunch of import export prices. And I'll just go through the numbers. This one, I actually have a chart. It was at minus 8.1, which is actually better than the minus 14.8 they thought was going to come out. And also an improvement from the minus 20 that came out in the previous report. These are just the numbers that I'll go through. Export prices, we're keeping an eye on these because of this tariffs. Now, it's probably too early for that to be showing up in the data here, but the market still looks forward at these things anyway. They were unchanged, where last time they were up 0.5%. You take out agricultural products, down 0.1%, where they were also up 0.5% last time, and down 0.1% with the import prices, where last time they were up 0.2%. You take out oil, they were up 0.1%, the same reading as we had last time, up 0.1% there. So here's the New York Empire State Manufacturing Index, less negative than what we saw before. Now, I ran across another chart which kind of breaks this whole Empire State Manufacturing down. The takeaway from this, and these are things that look forward, like what are the conditions going to be looking forward, new orders, shipments. You can pause this and read through all of this. Notice how all of these charts are going down, 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 down. You'll notice that two charts are going up. And that's what's making this report a little bit more negative. The prices paid, that's inflationary. That's going up, and prices received. What that might be nice to receive more money, but that means the customers are having to pay more as well. And so we're seeing the prices part going up with all of the other parts actually going down. So this is a little bit more negative when you look under the surface here. And Isabel Net, we look at this every Wednesday where it's an overbought, oversold composite. We had come all the way down to 7.71. That's an extreme negative reading. And then we bounced up from there. Still not very positive, but at least we're coming up to 27.58. Then April 9th was a record for advancing declining volume. And then what happens after that? Because we had that massive update that everybody was talking about. From everything I could see, it was more short covering rather than real convicted buying. It was panic buying that just kept prices going up. But you look out 1 month, 3 months, 6 months, and 12 months, and the returns are good. The further out you go, the higher the percentage, not only of the return, but also of the percentage, the win rate for that. And then looking at valuation, seem to be focusing on that a lot more these days. The one that I focus on here is the S&P 500, and I go through some different charts, both historical and then forward-looking valuation just for the S&P. This also takes other indexes, where the NASDAQ 100, that's all growth, and that's the big tech companies, the mega caps and the Magnificent Seven stocks coming in at 23. That's above that 20 level. We stick with the 10, 15, 20 scale. When we're above 20, that's considered to be expensive. And we're also up there with the Russell. Right now, these are the small caps. Now, the other index that I look at, that I go over on the weekend, looks at the forward, the small cap index. It has us down under 15. We're in the 14, if not 13 range. So there's a little bit of a discrepancy there. But what we've been seeing lately with the S&P, that's pretty much what I show over the weekend. I don't really look at the equal weight all that much, but we want to keep an eye on that one. That would be considered fairly priced, and then the mid caps are actually under 14. So the mid caps and small caps are more closely together with the chart that I usually use. All right, consolidated equity positioning falling down under this -1 area here. That's extreme negative. And then a sentiment gauge here where it had been lower and it's starting to come back up. This is put out by Goldman Sachs. And when it gets a really low reading like this, we use it as a contrarian indicator, but we use that for the American Association of Individual Investors. We use that with the Fear and Greed Index. We use that with a lot of different sentiment gauges, and they've been extreme negative now for weeks. For individual investors, we're going on 7 weeks now. We usually come down, hit this, and V bounce out of these things. So I don't know if you could really plan on this being a contrarian indicator because it might sit down here for a while. I would use it with other sentiment gauges to kind of get a feel for what's happening. Then the aggregated U.S. equity futures positions, where you're still seeing a lot of those positions are open, even though you're seeing a lot of the positions that they have relative to the 200-day moving average getting down quite low. Now, this is starting to get extreme, where we had some big things happening here going back to 2010, and then we were able to bounce up out of that. But the what we're seeing here is a real disconnect. You see where the blue line and the green line stay pretty close to each other? Well, here the blue line's up here. That means they're still holding on to those positions, even as the value of those positions are going down. Now, what's going to happen? Are we going to be able to bounce back up off the 200-day moving average indication that's given here? Or is the dark blue line going to have to come down, meaning there's more selling, which could put even more pressure on the market? And discretionary, that's when you can kind of pick and choose and do some market timing. That's the green area here. It's holding up a little bit better because people can say, oh no, the market's going down. I'm going to get out right now. Where if you use a systematic strategy where you just do the same thing and you don't really pay attention to what's going on in the market, that is underperforming. And that's what we see. When the markets are going up, the systematic approach tends to work better. When the market's starting to go down, that's when the discretionary tends to work better because people pull the trigger on things. And what about looking to go into a recession? We reversed our recession call after the tariff pause, but still see a 45% recession probability. That's Goldman Sachs here. They're bumping it up here, and we're seeing these numbers getting revised up. The Bloomberg consensus is at 30%, where Goldman Sachs is at 45%. And oh, I hit the wrong button there. And then breaking it down on ownership, where you still have households that they're the biggest owner of stocks, whether it's an IRA, a pension plan, or some type of 401k. It it's a big part of people's retirement, and 38% of households do own stock in some way. And then it breaks it down according to the other classifications here. This was kind of interesting too. This is looking at, and I've been really harping on the growth versus value, offensive versus defensive, and this is another chart that just kind of shows us where the S&P is up on top, and we're seeing the defensive sector in dark blue that's outperforming. Now this is longer term, and it measures it a little bit different way than what I measure it here. And we're seeing the offensive, that would be growth, where defense would be value. And you can see where the dark blue line is crossing above the green. And that's kind of lining up with the charts that we see. And then you take the offensive, defensive, or growth versus value, or however you want to call this. And then there's the spread between the two where we were seeing a negative divergence here. Okay. And then we're showing how this is down below zero. And that just means that value is still outperforming growth. And then looking at this last week, if you watch the videos that I do kind of regularly, I was talking about the Bollinger Band's percent B indicator. That measures when we're outside, in this case, the lower Bollinger Band, which tends to not happen very often and it tends to not last very long. Well, a week ago, we were seeing something that we don't see very often. We were seeing an extreme reading on the daily chart and on the weekly chart at the same time. They usually don't happen at about the same time. That was actually positive because when we see both the daily side and the weekly side, two different time frames lining up together, that kind of gives us more confidence that maybe something's going to happen because we're getting this extreme negative reading. So we look at this after the percent of stocks below the lower Bollinger Band goes from 67, greater than 67% to zero. That usually looks pretty good. Now, not necessarily a week later, which we're still kind of in that window now, but going out 2 weeks, a month, you can see how the percentage win rate and the return tend to go up because that quite often will mark some kind of low in the market. Okay, here is the chart. Really kind of boring. Had a flat open, stayed about the first half of the day above the daily pivot and the second half of the day below the daily pivot. Not really all that exciting, but probably pretty welcome by a lot of folks. And we are dropping off here in the initial overnight session, as I mentioned, news about NVIDIA. We were actually looking more positive here, and then we started to drop down before the market opened, and then we came back up to have a pretty flat open in Tuesday's session. And not really seeing any clear leader here. When we look at the intraday growth to value charts, the red line and the blue line are kind of right on top of each other. And we're not really seeing any follow through yet with our growth to value ratio intraday for the S&P. We want this to go up if we're more positive. We're just kind of leveling off right now. Then the end of day chart where we were actually up a little bit with growth where value was down. So it actually outperformed for the large caps. It was down less for the mid caps and down less for the small caps, but not really seeing much of a change here. The small cap growth to value that is above its 50-day and 200-day moving averages, but so this is actually looking a little better. It's too bad the index is just not doing all that much. We're still underneath the 50-day moving average with mid-cap growth to value and still below both the moving averages here with S&P growth to value, and we're now working off of a death cross. Now there are different ways of measuring trends. That's just the trend of this ratio that we're seeing, which we want it to be positive. When growth is outperforming value, that's more positive. Now we're seeing that the trend is going down. Not really much of an improvement here with the growth to value ratio that we look at with these ETFs. And staples to discretionary, not really doing all that well either here in the same sense. And we are dropping down below the moving average now. This suggests a weakening trend, but it's still a trend because we're above 20. We're seeing the red line coming down. Not much of a change with the green line, but it's negative because the red line's above the green line. Also dropping down, no longer extreme in the short term with the ADX, but it's negative because the red line's above the green line. Volume really dropped off. We've seen 2 days now below average. In fact, Tuesday's session was even more below average than Monday's session. Still getting a high reading with the ulcer index as remains elevated. And we are still over 30, just barely, but we want to get back down under 20 to be more positive with the VIX. And as the VIX has been coming down, the VIX of the VIX has also been dropping. And we're just about ready here with the MACD to cross over, suggesting that the momentum for the VIX could be to the downside. And kind of chopping around, declining a little bit here with this fear gauge, and also ticking back up just a little bit with this other fear gauge. So just not a lot of conviction currently. We saw a real spike up here with the daily chart of the equity put call ratio. So we're going back up with the 5-day chart. And this hadn't updated yet, but we are going up with the 10-day chart and with that big spike up on the daily chart. This is probably going up as well, which tends to be more negative That means more hedging is going on. And as I've been talking about in other videos, we're having a 3-day weekend. It's a religious holiday. We're coming out of the Jewish Passover time and the Christian Easter time. Folks are probably going to want to be hedged ahead of that. So just be aware that the market's closed on Friday, and I really hit hedging hard. And so that's something, if you want to learn more about that, I do have a program. There's a link below this video. You can come check that out and learn more about hedging. Okay, and then the volatility risk premium looking forward. Not seeing a lot of risk according to this. It's really dropped to a low reading now. We're still seeing the same thing here with the advanced decline line. Positive above the moving average based on price, improving, but still below the moving average based on volume. Came down a little bit, still below zero with our advanced decliners over the last 10 days. We're showing some improvement here, but it's not because we're seeing new highs. We're seeing less new lows. So that's starting to turn our 5-day chart back up, and we're flat now with our 10-day moving average chart. And still hanging out just barely above the midpoint with our advanced decline ratio, both in the short and intermediate term. Coming down, but still above the red line with accumulation distribution. Pretty much flat. The histogram has been coming down a little bit, but for the most part, the red line's still going up, so this would be considered positive. We did decline with the Chaikin oscillator, but we're still above the moving average. And we're flat here with the red line with the vortex. The green line is trying to make a comeback, but when you read this, it's still negative because the red line's on top. And seeing a bit of an improvement here with the 10-day average of the highs and lows for the S&P, but we're still below 50. We had come quite a low reading, and it is bouncing back up slightly, but not really seeing all that much here. We're just about on to slightly below the moving average with the S&P when we look at the advanced decline line, but all the other indexes, the NYSE, common stock, the mid caps and small caps continue to be below the moving averages, and the moving averages are starting to go down as well. And then we look at the 5-period moving average of the highs and lows across the broad market. This is improving. We had dropped down below this red line here at minus 7,000, and now we're bouncing back up. So that's showing slight improvement, but it's still below zero, so it's negative. Not really much of a change here with those stocks in the S&P above their 20-period moving average. Ticked down a little bit with the 50-period moving average steady, the 100-period moving average steady, and the 200. So really no changes there. This is what we're watching now. The 50-period moving average is starting to cross below the 200-day moving average. That's called a death cross, and that means the longer-term trend for the S&P is now negative. Now, we could still bounce all around here. Doesn't mean that we're magically going to keep going lower. It just means that all this weakness that has been coming into the market is causing the trend to become a downtrend. And there's going to be folks that change things around. In the program that I have, once we cross below this, then we start focusing on different things. And there's probably millions of money managers out there and individual investors who are going to be focusing a little bit different. This is how a lot of people make their decision. When the blue line's above the red line, you're long. When the blue line's below the red line, you're either out of the market by getting out completely, or you're actually looking at short positions using options and ETFs that actually benefit if the market goes down. And I cover all that stuff in the program that I have. And then rate of change going back over the last 5 days, because we hit that bottom and we've been coming up out of that. So we're still getting an extreme positive reading there. Not much of a change here with the 20, 50, and 200 period moving averages. Still extreme positive with the Stochk RSI. Still above the midpoint with the Williams percent R. And we're just a little bit above the midpoint with the CCI 14 and a little bit below the midpoint with the CCI 20. These are our short-term oscillators here. They're not really showing an awful lot of conviction yet. Another short-term chart that we have here is the short-term stochastic, where we're above the midpoint, starting to come above the midpoint with the intermediate short-term and still below the midpoint with the long short-term stochastic. So nothing extreme there. We did decline a little bit, but we're still positive with the force index. We're seeing an improvement though. We're above both the double and triple exponential moving average lines here, and that's turning these lines ever so slightly back up. And that could help the short-term trend to improve. And you can see here for 2 days now, we're hitting This 20 period exponential moving average, I think I misspoke in yesterday's video. I called it the simple. The blue one here is exponential, which it moves faster because those prices are weighted closer to current price, where a 20 period simple moving average treats all 20 periods the same, just adds them all up and divides by 20. But we're having a difficult time getting above these levels here. So this is acting as overhead resistance now for 2 days. And when we look at the standard deviations chart, we're also having a hard time getting above the midpoint. You're seeing where the 20 period moving average and the midpoint of this study are just about at the same point. And this is another way of looking at inflation with trueflation coming in at 1.42%, well under that 2% level that the Fed is targeting. But it's not like the Fed, I don't know if they even look at this. So this is a newer chart that I'm just kind of testing out to see, is it really all that helpful? Intermediate term, we're still below zero here with the balance of power. We're still leaning a little more neutral to negative here because we have the lighter shade of purple with the go, no go charts. Here's another one showing that we're coming right up to this midpoint for 2 days in a row and can't seem to get above that with the highest high, lowest low value chart. Just barely on the black line right now. We're still extreme, but this is showing some improvement with the TTM squeeze, and it's a lighter shade of red. And we're coming down as stocks have been slowing down lately here. So we're coming down with the speed. That's what standard deviation does. It just measures speed, not direction. Improving, but still negative with the ease of movement. Also, still below zero with the Arun. That's negative. And we came down, but we're still above zero with the S&P McClellan oscillator. So we're going up based on price and volume. So this is a primary indicator, as I call it, and that is remaining positive for right now. And we're also above zero with the NYSE McClellan oscillator. So when that's above zero, really hard to see here. But for 2 days now, we've been ticking up based on price and volume with the NYSE summation index. Still looking positive here. The Swollen Trading Oscillator crossing above the midpoint, both based on price and volume. Trying to improve with our momentum oscillators, but they had given us such extreme negative readings. They're having a hard time actually turning back over positive, but they are showing some improvement. We're also turning up based on price and volume, but we haven't crossed above the moving average at least yet. And not seeing any extreme readings now. The PMOs that are rising, that was showing some strength, even though it backed off on Tuesday. The buy signals are no longer extreme, so we're seeing an improvement there, and we're starting to turn back up with the PMOs that are above zero. And these are all of the PMOs inside of the S&P 500. And we're still positive with the Elder's Impulse system for the S&P, and we did switch over after Friday to seeing the parabolic SAR. Actually, it was after Monday where we're seeing the parabolic SAR positive since the dots are underneath. This is another primary indicator. Turning back up, it's still getting an extreme negative reading with the slope oscillator, and we're actually crossing above the moving average with the MACD. This is more short term to intermediate term, and a lot of people use this. This was one of the very first momentum oscillators I ever learned about way back in the early 90s. So we are turning positive with the TSI. That's one short-term oscillator that we look at. The slope is trying to improve, crossing back over positive with the MACD. Not quite there with the PMO, but we are crossing above the moving average with the PPO. These three are intermediate term, where the long-term oscillators trying to slow down the decline and flatten out here with the tricks and KST, but they're still negative. The copy curve trying to turn up, but is still negative and possibly even extreme negative. These are low readings, similar to what we were seeing back in 2022 when the market was in a cyclical bear market then. No longer extreme with the Sean trend meter, but not really showing any strength right now. Improving, but still below 50 with the money flow, but we're above 50 with the ultimate oscillator. We're still below the moving average with unbalanced volume. We're still below 50 with the intermediate and short-term RSI. And not really seeing much of an improvement here with the intermediate term trend based on 50 periods. We did come right up here to the double exponential moving average, and that's acting as overhead resistance, but the lines are continuing to go down. We need to get above these lines for them to stabilize and actually start to turn up. And we're still below all the plotted moving averages. Here you can see where we're hitting the 20 period exponential moving average currently. And we're not far away from the 20 period moving average, but we are far away from the 50 period. We're still showing that as extreme negative. Still seeing an improvement here, though. The bullish percent index above 30 and advancing above its moving average. This would be classified as positive and improving, but not quite out of the extreme negative territory here with the NYC bullish percent index and actually looking more positive with the NASDAQ 100 bullish percent index. It it is positive now, but it will be confirmed positive if we actually go above 50. Still wondering what's going on with the mass index. Is this the reversal that we're seeing right now? Because that's what it was trying to pick out. But we're also potentially seeing another signal that could be given here very soon. And not really seeing much resistance here right now. I wanted to show this. This is the 20 period simple moving average of the open, high, low, close. Not really hitting any of these lines and coming back down right now, but it's negative because all these lines continue to go down. And we're looking more positive here with the hike in Ashi. This is different ways of measuring the trend. We're still negative, but pointing up with the Kegi chart. We're actually turning positive with the Renko chart, and we're looking more positive with the three-line break. So these charts are picking up some improvements. Long term, we're still extreme with the 150 period moving average, but we're not quite extreme anymore with the 200 period moving average steady. And still, no real changes here. Negative across the board with the mid caps and small caps on all the time frames. Still negative in the short and intermediate term, and the Nasdaq 100 is a negative in the short and intermediate term. And everything is negative with stocks, bonds, commodities, and the dollar, where you have bonds and the dollar are negative longer term. And this was encouraging. Didn't show the real big strength that we would like, but we see tech and communication, they were the better performing areas. Discretionary wasn't, but tech and communication, those are growth areas. We like that the financial sector is doing better. And staples underperformed. We like that too. Healthcare ended up being down as well. So it shows some improvement, but not an awful lot of conviction. So we're getting kind of a mixed picture here. We had positive signals right after the open, with utilities having a bullish MACD crossover, as did the industrial sector, as did the Dow. Then the dollar had a 50-20 moving average crossover. That's what we're seeing with the S&P right now, which they don't have that on here, which is kind of strange. All right. And then the Nasdaq, it was above 16.9, then it dropped down below 16.8. Communication, that's a growth area. We had a bullish MACD crossover. The financial sector, we like that. That's a bullish MACD crossover. And the dollar was able to get back above 100. And then eventually we dropped below 5,400 with the S&P. And we're still close with the Dow, but the 50 period still coming down to the 200 period moving average. We are still positive with the diamonds with the Elder's Impulse system. We generated a death cross last week with the Nasdaq, so that's now in a downtrend. But we're still positive in the short term with the Elder's Impulse system for the Nasdaq. Also, the Nasdaq 100, that's a newer addition to the list. It's now showing a downtrend here. But we're still positive in the short term with the QQQs when looking at the Elder's Impulse system. The momentum for the Nasdaq 100 is now switched back over to positive. Small caps just really having trouble now. The S&P 600, that was the first index to give us a death cross, and we're well below the moving averages here. Also, the Russell 2000 small caps also in a downtrend, trying to improve with the momentum, but still below 50 with the RSI on top. And we're still neutral with the Elder's Impulse system for the small caps. Also, we had the mid caps generating a death cross here. That's in a downtrend, but we still remain more neutral in the short term with the Elder's Impulse system. Seeing a death cross here with the Wilshire 5000, a broad market measure, and just about getting ready to cross over with the death cross with the total US stock ETF. So that's another broad market measure. Financial sectors trying to regain some traction above its 200-day moving average. That's showing some improvement. The FANG index, little ways to go before it generates a death cross, but it's headed in that direction unless we see some real improvement. Apple was virtually unchanged on the day, in a downtrend now. Amazon, Still in an uptrend, but that's looking threatened now. It was down 1.39%. Microsoft is in a downtrend, having a really difficult time getting back above its 50-day moving average. Meta also showing some weakness now, down 1.87%. Google is also in a downtrend, down 1.74%. NVIDIA, which is probably going to be down even more with that after the close news that came out, and really having a hard time getting back up to its 50-day moving average. Tesla, we're seeing a death cross here. Even though it was up, it spent so much time underneath the 200-day moving average and below the 50-day moving average that we're now seeing a longer term downtrend. Which Netflix is still looking better. It was up 4.83% and was able to get back above its 50-day moving average, and still seeing a fairly strong short-term correlation between US and world stocks, and it's also improving with the longer-term correlation here. Oil continues to be in the low 60s, and that's not inflationary, and that could be more helpful. Where the dollar was able to get back above 100 with the US dollar index, and we're coming down here with the 10-year yield after it really spiked up in a short period of time last week. This is more encouraging. So we're coming up again based on price with the 10-year. Our growth to value ratio is not showing all that much of an improvement with the Qs to S&P. We're still above the moving average, but discretionary to S&P declined. We declined, but we're still above the moving average when we compare large cap growth to value. So the large caps are above the moving average, as are the mid caps, coming down a little bit, but the small cap growth to value is actually looking about the best right now. So what's the outlook? There will be a meeting on Thursday of the European Central Bank. They're expected to cut rates 0.25% or 25 basis points, and the markets will be closed on Friday for Good Friday. No real changes here. We're still negative in the short and intermediate term, and we're switching over here. I'm going to give it another day before I officially change this because we're just crossing below it now. We're still considered long-term mixed. And let's see, I forgot to update this. So let's go look at the next one. The big report of the week is probably going to be retail sales. And we're also going to get industrial production and capacity utilization. The big one on Thursday is going to be jobless claims and continuing claims. And here is a look at Wednesday's economic calendar. Seasonality neutral to positive with the Dow, where the S&P and Nasdaq are positive for April 16th. And we do see some positive seasonality in here, but then we kind of tend to chop a little bit lower. And also remember, if you do options, they're going to expire on Thursday this week instead of Friday because of Good Friday. All right, so we're now looking more negative with the long-term growth to value ratio for the S&P. And that had held in there for quite a while, but it's now turning more negative. The oscillators for the S&P are still negative, but improving. Moving average studies, no real improvements on Tuesday, but they're trying to improve in the bigger picture, but they're still negative. The ease of movement is negative, as is the money flow, the vortex, and the long-term special K charts, a very long-term oscillator. It continues to be negative. We're still hanging on to being positive with the smart money indicators, so that's more encouraging there. Discretionary to staples is still positive, but in the short term, it's spent a lot of time under that 200-day moving average. And we are positive with the S&P and NYSE McClellan oscillators, as well as the summation indexes. Parabolic SAR is positive, as is the Swinland Trading Oscillator. The bullish percent indexes, you could still say that we're extreme negative with the NYSE, but we're seeing a real improvement with the S&P and the NASDAQ 100 bullish percent index. The ultimate oscillator is positive. It's above 50. The financial sector getting back above its 50-day moving average. And the momentum for the NASDAQ 100 is now positive. And then we're wondering if this mass index reversal, I'm still keeping it on the positive side. We'll just see if that ends up being anything. So our conclusion, we are still negative in the short and intermediate term. You could say we're now negative in the long term. I'm going to give that another day just to see it drop a little bit further below, I guess. So no real changes here. Negative, we are still showing some oversold conditions with improvements in both the short and intermediate term. And we're starting to go even full out negative now with the long term. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.